All right, here we go. Hey, Skylar, how are you?
Great. How are you, sir?
I'm doing terrific. We're here in New Jersey. We haven't caught up in many years. I
Yeah,
think
long
it's
time.
been over 5+ years. So, by way of background, I was an investor in Skylar's hedge fund, Regan Capital. And at the time, this is back in like 2011, Skylar, your fund was making markets. Well, I wouldn't say you were making money by making markets through your hedge fund and trading in non-agency residential mortgage-backed securities, which is
Right.
implicitly in the housing market. We'll come back to what all that means, but it's great to see you again. I know it's been a long time, and we're going to talk about the Fed rate outlook. Bill Ackman's comments, thoughts on the housing market. There are multiple components to that part. Where's their risk-reward imbalance? Where's their value? And if you have any other questions you want me to ask Skylar, just making note in the thread, and I'll be able to see it here. So, Skylar, your background has been in the bond market. I've got your bio here. You were at Cantor Fitzgerald from 2007 to 2011, trading consumer asset-backed securities. You're the head of residential and consumer asset-backed securities,
Yep.
and you were at a number of firms, and you managed P&Ls, and were generating tens of millions of dollars, in P&L before you decided to go out and create your own hedge fund.
That's right. Yeah, I've
And
been doing this my entire career. I started in '01 at one of the largest mortgage originators in the country, GMAC RFC. It was a General Motors company that eventually became ResCap, that eventually went defunct. But we were one of the biggest buyers of what's now called non-performing and reperforming loans. Back then, they were called scratch and dent.
right.
So I got hired as a loan level programmer modeler to model defaults and prepayments, and we were buying these at 70 cents on the dollar and getting them reperforming and then securitizing them into deals at 96, 97 cents. So that was 22 years ago now, and the market's kind of come full circle, and here we are again, and opportunities abound.
Exactly. So, do you want to walk us through the post-2008 crisis briefly? And obviously, we had the banks pulling back substantially. Capital requirements and the loss of ratings forced the banks to expunge their balance sheets of certain securities, including residential mortgage-backed securities, which were also credited for almost taking down the banking system. Do you want to walk
Sure.
us through that period? And then we'll get caught up to present day.
Yeah, in the nature of banks is such that of leverage. You're putting in $10 million of equity. You can then go borrow vis-a-vis deposits or CDs, $100 million, and you can use that $100 million to go buy securities and or to lend money, traditional mortgage loans, C&I loans, etc. So between 05 and 07, there was a tremendous amount of securities that were created that were AAA rated to satisfy the regulators, and so that banks could put them on their balance sheet, and insurance companies like AIG. So you do the math, and back then you only had about, if you lost 10 cents on your $100 million, 10%, your equity's gone. And that's really what happened to Silicon Valley Bank recently. And we can go through that. But the aftermath really was banks had to delever. The banks who really didn't have a lot of this on their balance sheet or were able to get rid of it quickly, including their the liabilities in warehouse lines, et cetera, that they had with their customers. Whoever moved quickest was fine, and or whoever didn't put a lot of leverage instruments on their balance sheet were fine. So in the aftermath, you had about an 18-month time period where there was really no bid. And I remember I was going over to Pine River, going to Soros, going to Paulson, educating them on these mortgage bonds of, hey, you probably made a good amount of money shorting these. Now you can buy these, and they're legitimately, could be 5Xers or 20Xers in terms of return on investment. So The first mover at that point was really global macro. Third point, Soros, Paulson, Pine River. Then 2011 to 2013, a lot of managers left the street to go form their own shops that specifically were looking at going long this trade, and the trade still exists.
Axonic, the rise of structured credit hedge funds that help create these products on the sell side.
Right.
They sort of blow up the banking system, then they move to the buy side, create a fund, and they were benefiting from the non-economic selling of the banks. They knew where the bodies were buried. They knew where value was. Yeah,
and going into the crisis, there were only a couple of RMBS, ABS hedge funds. There was the Bear Stearns' fund, Halcyon. There were only a couple that were. This is all that they really did.
You had like Meta Capital and SPM on the rate side, but not so much in credit.
Exactly. Yeah.
So then your firm saw this opportunity to create liquidity in the market. So the banks, when they weren't able to make markets, they'd lost their ratings and capital requirements had forced them out of the system. And that's when we met. I think it was 2011-ish, plus or minus a year. And so Regan, at least at that point in time, the way I would describe it is you were making market in these securities because it was an orphaned niche, capacity constrained asset class.
Right.
And so you were buying low, selling high, and doing that in a lot of turnover, which is what a market maker does.
Yep.
And capturing bid-ask spread.
Yeah. So moral of the story was that banks still had a lot of this on their balance sheet. Very similar to where banks are today, where they own a lot of paper. They know it's distressed. They actually don't really even want to make markets in these. Or you had desks that went from a head count of 20 to a head count of maybe 4, a balance sheet of 2 to 3 billion to a balance sheet of maybe 100 million. So, there was a lot of money to be made being the pseudo middleman. Okay. Right. And the mechanics of the bond market are so much different than, especially in our market, which is primarily over the counter. Hardly any of it's electronic trading. So there is no marketplace where you're going to actually sell bonds.
Call someone on the phone. They have to know you. They have to give you access.
Yes.
If you're a retail investor or even a family office, you can't get in this market. You have to know people at specific dealer desks.
Right. Yeah. So it creates illiquidity, but it creates advantages by, if you're in the know, if you have those relationships, you can actually buy and sell. But to this day, you can't walk into a JP Morgan or a Fidelity or a Schwab and say, I want to buy a mortgage bond. They'll look at you like you have, 2 heads.
The best is ETFs. And you mentioned Pine River. They had 2 Harbors, which is their ETF.
Yep.
But obviously you pay fees on that and you can't do security selection and find that idiosyncratic value.
Yeah.
So the banking sector, there are a couple of differences between then and now. So then it was a credit risk story. You had an impairment on these securities and that ripped a hole in the bank balance sheet. So the banks were levered between 10 to 30x, 30x if you're an investment bank, 10x if you were a consumer bank. Here, of course, with SVB, that was more an interest rate risk story. The regulators post-08, they said, all right, let's clamp down on credit risk. Let's encourage banks to own high-quality liquid assets, HQLA, give them favorable regulatory capital treatment for that. Then SVB and a few other banks loaded up on those securities, which are treasury bonds and mortgage-backed securities, which are AAA. They declined in value. A couple of banks went down. Obviously, banks today still have around 600 billion plus in unrealized hold-to-maturity losses. The Fed's created a facility for those securities so they can fund at par value, which is above the market value of the bond.
Sure.
Help inflate the bank balance sheet, help them hold to maturity. So that brings us to today. Covered 12 years in 12 minutes. Not bad.
Yeah. Right.
So where we are today, we've got this housing market, which is really quite a dynamic story. We've had the fastest pace of rate increases since 1982, and home builder stocks have been on a tear, and they're creating new supply of homes, but there's a capacity constraint around that, meaning, but on the other side, you got a locked housing market. People aren't moving. I told my wife we got a 2020 COVID mortgage in June. I said, we're not moving until that bond pays off in 30, I guess we're 27 more years to go, whatever it is.
Yeah.
But you walk us through what you're seeing in the housing market, the impact of rates, and what do you think the outlook is?
Yeah, there were a couple interesting charts popping around just this past week about new home values, i.e., like builder, new home builder home values that were down, I think something like 18%, whereas existing homes were up year over year, 3 to 4%. And so it really shows this bifurcation between those folks that don't really have to move, i.e., if you're in your home and you have a low, I think something like 80% of mortgages out there are less than a 5% coupon. Morgan Stanley has a metric out there, the share of loans out there that are in the money to refinance, and it's like 0.3%. Okay. So if you're in an existing home, in an existing mortgage, yes, there's very, very little incentive for you to move. But builders are in a different spot. Okay. Builders are on a shot clock of between 6 and 18 months where they have a construction loan, then maybe they have a perm loan. And those are usually expensive loans. Okay. So they're building in obviously a profit margin, but that profit margin is quickly going away. And so they're in the moving business, literally, not the storage business. And so they have to move as quickly as possible to be able to move on to the next build. So that metric of, you're looking at Boise, Austin, some hot cities out there that are down 10 to 20%. It was the froth. It was the cities that were up, 50 to 70 that are now down 15 to 20. And it looks cool. These got, housing's falling everywhere. But in reality, it's not. It's going to be a very, we're all kind of lobsters in a pot right now, and the water's getting warmer.
So you were referring there to single family residential in terms
Right.
of those price drops across those markets. And we see some stress in multifamily and obviously commercial real estate as well, which is a different sector of the market. So the home builders are benefiting from the fact that existing homeowners with a low rate mortgage don't want to sell because they can't refinance without paying more.
Right.
And therefore that's created a bid for home builders to create new products. So home builders have done well. On the other hand, developers of commercial real estate multifamily that took out these short-term construction loans are in a world of hurt, obviously, because rates have increased 500 basis points. And then they got the work from home issues on top of that. So there are a lot of cross-cutting effects and players that are benefiting and hurting the real estate sector.
And I think, if you want to create a timeline for it, if rates do stay high, who's going to be hurt the worst in the first? It's look to those folks, that have the most amount of leverage, or those companies that have the most amount of leverage. And that's why it's started with banks, because banks are 10x levered. Okay. And that's a caveat there. They were 10x levered going into the last 2 years. Now they're potentially 20 times levered. Okay. So if you had $100 million in assets backed by $10 million in equity, and those assets fell by, 5, or call it 10%, you're in a world of hurt right now. So you're seeing some of these banks that are like 20x levered now. Okay. And so a lot of these banks, you can do the math, about a third of their portfolio was in fixed income. That fixed income's down 10 to 20%. Okay. So if you had 33 million and it's down 20%, okay, you're down $6.6 million. So now you have only basically 3.3 million in equity supporting $93 million in assets. Do the math. That's 30x leverage. Right. So you start there, and then who's the next most levered? not private equity per se, but yeah, private equity, LBO companies, where, going in LBOs were 6x, 7x levered. You look at the bank loans is a large industry, leverage loans. Most of those companies were 6, 7x levered. Okay, so they're going to start seeing pain. Then it's going to be high yield. So that's one part of the equation. And the other part of the equation, you talk about residential versus multifamily. Okay, residential loans are typically 30-year loans. Multifamily are typically 5-year bullets. Okay, so if you were smart, you refinanced or you took out a loan in 2020 or 2021. So look at the calendar. We got 4 to 5 years left. If that, 2 to 4 years left for those folks to actually come up on a refinance. Okay. And if you took out money at 25% equity, 75 LTV, the estimates I've seen on multifamily is they're down 20% to 30%. Voila, all your equity is almost gone.
Right.
Okay. Further to that, rent growth is, really non-existent. And so the banks, they need to CYA. And when they go to re-underwrite that, they're going to say, hey, we got to re-underwrite this to a 1.3 DSCR. You got to come up with an additional 20, 30, 40% equity. So there's a conflux. There's two things that are happening, which is A, who is the most levered, and B, who has to refinance their debt the soonest.
Right on. So DSCR is a debt service coverage ratio, and C&I loans are commercial and industrial loans, things like commercial real estate loans, just to connect it out. So let's walk through each of those categories now. So we talked about the banks. Banks are first line. Now the banks also have loan to value. So they have subordination in the form of the developer's equity. Now the issue is that equity is getting wiped away because of the math you just walked us through. They got to finance. And meanwhile, the banking system's got an 8% drawdown in deposits.
Yeah.
The banks are bringing it in tight, and they've raised lending standards.
Yeah.
And they're still going to insist on equity to do the refinancing. So it's a world of hurt for owners of those assets that are in a first loss position. That's short-term financing loans.
Right.
On the bank side, now we've got the mega banks, we've got the regionals, we've got the community bank. I don't think the mega banks have issues. They're not in the business of local commercial real estate loans. That's more of the business of regional banks and also community banks, but it's also region dependent. The geography you're in, the nature of the business model, where they specialize. You have some banks that are heavily concentrated in New York City office, for example, and other banks that issue credit cards. And credit cards are not the same thing as New York City office. So, and every bank has a very distinct kind of business model. So there's opportunity to identify winners and losers in that sector. Where do you see the winners and losers between like regional banks and community banks?
Well, there's a go forward and there's a look back. Okay. On a go forward basis, it's an incredibly opportune time to be a lender. Okay. On the equity side, if you're talking about real estate investment or private equity, it's extremely precarious because you can't underwrite cap rates going back to 4. You don't know where rents are going. They're not going up 30%, a year anymore. So you have a lot of variables. On a go forward, and I'll talk about go forward, then I'll talk about look back. Like on the flip side, I just had a conversation with a firm that's doing builder loans. They're lending to home builders at 12% plus points up front. Okay. At a 75 LTV. I'm buying mortgage bonds at 9 or 10% where the underlying borrowers have 60% equity in their home. And then they've been in their home for, 17 years. You can go out and you can buy agency government guaranteed paper right now at 6 to 7% yields. So it's an incredible time to be a lender. Now, community banks and regional banks that have, it used to be a really good metric that bank analysts looked at. What is your loan to deposit ratio? They really liked you to have a high loan to deposit ratio. So if you have that 100 million in deposits They want you to have $100 million in loans, which is 100% ratio. Okay. Now, where were all those loans struck? Let's just pull a number out of my hat and say they were struck maybe at 4.5%. Okay. Where are money markets and T-bills right now? 5.25%, 5.5%. And so if you're going out and you're getting new deposits right now, because those old 0% deposits have left the building, you're funding at 5 handle and you're lending at 4 handle. That doesn't work for that long. Further to that, and I think something like 70% of commercial loans that came due last year were extended. They weren't actually paid off. So this is a reprise, really, of the S&L crisis. Okay. Banks don't want to be in the property ownership business. They want to be in the lending business. Okay. Not only do they not have the expertise, they get better regulatory treatment to be a lender than a property owner.
Right.
So they're going to do everything possible to pretend and extend.
Right. Not happening now. Right.
It's what's happening now. Okay. We'll give you, how much time do you need? How much, remember that scene in National Lampoon's Vacation where he's paying for the car repair and he's like, how much is it? And he's like, how much you have? Like, open it. Well, and he just takes everything in his wallet. Like, yeah, just give me everything you have to pay me what you can. Right. And that's kind of the situation that I think banks are in right now, where there's going to be a long workout unless you're just so underwater that let's just say you bought it for $100 million. You got $25 million in equity to start, and it's worth $50 million.
Right. Then you turn the keys. You just walk away.
Then you're just like, it's not even worth my time to try and get the value back.
Well, we're seeing that happen now. I mean, we're seeing the keys being turned in downtown LA, Milwaukee, Brookfield, Blackstone.
Yep.
So the earlier PE vintages, and this is a slide that you share with us. It's a lovely slide here. So if I were to pull it back on this chart here, what you're saying is, look, banks issued mortgages in this period, a low rate world. And then rates and spreads widened. That means the value of those bonds fell. That's the same statement. However, new issue, those folks are going to do really well because they don't have the back book that got repriced lower. They're not experiencing impairments on their balance sheet due to old mortgages that were issued. They get to issue new mortgages at high prices. And the other point you made is that these non-bank lenders, these private credit lenders, are stepping in to fill the gap, and they're charging a 12%, interest rate.
Right.
So not a bad business to be in, and you get to re-underwrite based on the current environment.
Yeah.
And you get to pick and choose because there's less financing to go around. You can be more selective on the assets you finance. And the other point I think which is critical too, is that you're taking on, in some of these cases, U.S. government risk.
Yeah.
You're not taking on the risk of a private company.
Right.
And the return on lending to the U.S. government in the mortgage market is far more attractive than lending to the U.S. government in the Treasury bond market.
Yes. Yeah. I mean, this chart here shows there's this, if you look at the first peak, which was fall of last year, about 13, 14 months ago, right there. What is that? That is when QE stopped.
That's October 2022. Yep.
That's when the government stopped buying mortgage bonds. Okay. And they announced it a month or two earlier, but they're like, all right, this is it, guys. We're not feeding you anymore. So, oh crap. The biggest buyer in the market's gone. They were like a third of the buyer base. Then the second big separation was this spring. When SVB, you could see the peak here. It was, March, April of this year, where spreads widened out to almost 2% over Treasuries. And to put that in perspective, during COVID, they got to about 1.85%. So spreads actually got wider than COVID on its worst day, this spring. So you were getting compensated almost 2% over U.S. Treasuries for U.S. government guaranteed risk, almost 7% yield to buy, mortgage backs. Now, The other two lines I have here is corporates. Okay. In the blue, you have high yields, and in the red, you have investment grade corporates. They didn't follow the same trend, but these three lines have followed the same trend for a very, very long time. Okay. They move in concert. Now they're on three different axes here, but you know, what you still have this very wide spread to own mortgage bonds relative to corporates. And you can throw in munis, you can throw in bank loans. Why is that? Because corporates and munis are retail products, and there actually is money flowing into broad-based fixed income this year, but it's not going into total return funds, which are the biggest buyers of mortgage bonds. They're the next biggest buyer after the U.S. government and banks. So, you know, you got a third of the market left that's actually buying. But you know, all spreads. This has been a tremendous month. November has for everything, but you know, it's the same separation between mortgages and corporates here.
Right on. Well, this is a repeat of what we saw in 2022. In October, spreads are wide, and bonds rallied, and risk assets rallied, and it's a repeat of the same phenomena. This is the irony of the bond market. Like, yes, interest rates are wide, and you can go for the yield, lock it in hand, but at the same time, the discount rate on risk assets and equities is also high, so they're cheap.
Right.
So equities ripped and bonds ripped. Now, one thing to clarify here for listeners is, you know, why is it that taking risk on the U.S. government is wider in the mortgage market over the Treasury market? I'm going to jump to another slide here, which shows the reasons why, and it boils down to the fact that in the Treasury market, the U.S. government has a contractual obligation to pay you a certain amount of coupon and a certain schedule regardless. Whereas in the mortgage market, what's happened is the borrower owns the option to prepay whenever they want. And that uncertainty creates variance in the cash flow stream.
Right.
And investors demand compensation for bearing the uncertainty of having sold this put option to the mortgage owner, who can put that mortgage back to the owner anytime. Now, you have some other components too, Spread. You want to walk through some highlights?
Yeah, so go up one page here.
Sure.
Okay. So if you look at the top left, 6-month prepayment rate. Prepayment rate is the annualized percentage that borrowers prepay their mortgage at. Okay. And I'm just looking at, this is old mortgages, 07 and earlier. But you can see here on the top left chart, we're at basically the lowest prepayment rate ever, which is about 6%. So only 6% of borrowers are paying off their loan in full per year.
Those are like relocations and divorces.
Death, divorce, relocate. If any, you know, back to CFA materials, that is the drop dead rock bottom CPR that you would ever run any bond at.
This goes back to the point of no one wants to leave their home when they got cheap financing.
Right. Now go to if you look at the bottom left of this screen, current loan to value. Loan to values are at their lowest level ever, i.e. borrower equity has never been higher. So if we put that into some large numbers here, U.S. residential real estate market is estimated to be $50 trillion. There's only $20 trillion in mortgages. So you have $30 trillion in home equity. So on the one hand, being a lender, being owning the mortgage has never been a safer proposition. On the other hand, you know, nobody's prepaying. Okay, so you traditionally, when you buy a mortgage bond, you think, okay, 20% of these borrowers are going to prepay per year, so I'm going to get all my money back within 5 years, right? And this is what you have, a double whammy that's hurt the banks and the U.S. government and traditional fixed income investors. You bought these bonds 2 to 3 years ago thinking they were only 2 to 3 year bonds. Okay. You were estimating like a 25% prepayment rate per year. Now that prepayment rate's at 4. Okay. So I use those two numbers for a reason. 25 into 100 is 4 years. Okay. Your half-life of 4 is 2. But for CPR, 4% prepayment rate into 100 is 25. So these borrowers are estimated to be in their house for roughly like 22, 23 years, which
Right.
is a half-life of like 11 or 12.
So let me put it back. If you're a consumer, you've got more net equity value. So the consumer is strong. Their balance sheet has strengthened.
Right.
The bank is losing money for the issues we described. Private credit lenders are stepping in to fill the gap. But if prepayments are longer, and I believe rates are higher for longer, I don't mind a slower prepayment rate. I'm going to get longer effective duration.
And it comes down to, do you own the bond at par or do you own the bond at today's price?
Right.
Right.
Are you a new issue player?
Right.
Now,
and if you're a new issue player, yeah, you want the higher yield for a longer period of time. And I say double whammy because the government and the banks that owned these at par, 100 cents on the dollar, some of these are trading at 102. Not only have they lost money by interest rates going up, but the bond extended from a 2-year bond to a 10-year bond.
Right.
And that's always been the predicament of investing in mortgage bonds. Is if rates go up, not only do I lose money because the replacement value is higher than where I own it, but also B, it's extended. So those two things feed on each other.
That's the definition of convexity. Of course.
Yes.
Right.
So now this is the first time since the late 80s the mortgage market has been positively convex. So traditionally, as a mortgage bond buyer, you're selling the call option to the borrower for free.
Right.
Now you own the call option for free. Okay.
Yeah.
So if that CPR, the prepayment rate, goes from 5 to 10, and you're going into this assuming only 5 or 6% prepayment rate forever. Now, if that prepayment rate doubles or triples, well, you get your money back a lot faster. You have a lot higher IRR. Okay. So you're going into this on agencies and you can buy AAA paper at 6 to 7% yield at 80 cents on the dollar. If prepayments just go back to where they were 18 months ago, that's a 12 to 15% yield on a AAA bond.
It's amazing. And you get the pull to par if you hold it to maturity, which gives you capital gains.
Yep. So these are all par bonds. It's just a matter of, do you want to get the par? Do you want to get that pull to par plus the coupon in over 10 years or over 5 years or over 2 years? It's
really
there's
remarkable.
Many ways to skin the cat.
It's people making money from other people's mistakes, just like we saw in 2008. It's the new money shows up.
Right.
And you see the mistakes that were made around legacy origination. They see the non-economic selling. They identify what sectors to focus on, what credits to underwrite, and they go buy that at an attractive price. And the new issue side, of course, the private credit folks are stepping in to fill the gap in the banks. And the consumers hanging in there, doing all right. They're not moving.
Right.
Equity is strong. Now, on the bank balance sheet, is there enough subordination from loan to value to insulate them from violating their equity regulatory capital requirements? We know the consumer is strong.
Yeah.
We know commercial real estate is a shitstorm.
Right.
So, and certain sectors, commercial real estate, to be specific, office and multifamily and new, recent construction ones, we'll say that those are the three categories. So is there enough subordination into the loan to value? The fact that the banks are in a senior secured position relative to the borrower. So the borrower eats that first chunk of pain. Yeah. Can the banks navigate and get through to the other side?
I think so. I think the majority of them will, but there's going to be pain. There's definitely going to be more bank failures, more acquisitions. I think there is a lot of owners out there of community banks. We're talking 5, 10, $20 million equity types of banks. If you're a $10 million equity bank, they say you're a $100 million bank because you got like $100 million in deposits. So that $100 million bank, they are probably breaking even right now, maybe losing money. Okay. Because here's the issue on that bond you bought at par, it's a 2% yield. That's called a book yield. And that's all you can claim, even though the bond is currently yielding 6%. You haven't restated the market value on that bond. It's just bank accounting where
it's held to maturity accounting.
Yes, you have a 2% yield on your books.
Right.
And, if you're going out and raising new capital, i.e. deposits or CDs or borrowing from the FHLB or even borrowing from the government, they're charging you between 5 and 6%. Okay. So you're earning 2 and you're paying 5 to 6. How long does that last? So let's say you have $10 million in equity. It's a very slow bleed.
Right.
And this is why, if you look at the bank indices and where banks are trading, they're trading at 60 to 70 cents of book value. This is why.
Right. Citibank too. And I mean, it's all strata of banks, including ones that don't have direct exposure to these issues. Barclays.
Right.
Citibank.
So it's not, I think the government is there with the lending program. We're going to treat your securities as if they're worth par, but we're going to lend you money at 5.25.
So they're still upside down on the net economics.
Yes. It's
really
just a matter of time.
Right. So they're believing,
it's very similar to like venture capital. We're not making any money right now, but we're going to make it up with quantity, right?
Right. Right. I mean, the Federal Reserve is doing a Bagehot's dictum, right? Lend freely at a penalty rate of interest.
Yep.
So you can tap that facility, you can pledge that asset, but you're going to book 2% of net income, but be upside down 3 points.
Yeah.
So, and it's not an equity bailout too, just to clarify for some of the misperceptions out there. But I think there could be an opportunity for active management. I noticed in our 13F tracker, we track a couple dozen hedge funds. We see the positions that they're picking up.
Right.
I did notice some banks being dumped. I won't call them out on this chat right here, but I also saw other banks being snapped up too. And I would guess that they're doing the deep fundamental work to assess the quality of the balance sheet and picking up names with a cheap price to tangible book value. Baby got thrown out of the bathwater.
Yeah. And I think there's banks that make a lot of money from fee revenue. There's banks that have a really good,
wealth management
or wealth management or origination business. Not every bank's the same, but I'll tell you that, there are a lot of banks that are doing nothing. They're not buying bonds. They're just trying to
zombie banks, just like the S&L crisis. To your other point, they can't really do much. I mean, they want to call in the money, but they can't do that because the borrower needs to have time, so they're going to pretend extend.
Right. So they can raise capital.
Yeah.
But it's like VC. It's like a down round.
Well,
we got to raise capital at half the valuation that we were a year ago.
There's another. I'm glad you brought up that point. The challenge there in raising capital is you can't get a non-bank to have a control position in a bank capital stack. This is why none of the tech companies own banks. It's why the VCs couldn't bail out Silicon Valley Bank. It's why private equity cannot show up with a bazooka and inject capital. They can up to like a 9.99% level. So I think what you shared here is a non-consensus view, which is we love. We're all about non-consensus investing, right? That this thesis should come to the fore next year because you've got that upside down economic story, which, by the way, the Federal Reserve balance sheet also has. The Fed is long a bunch of 2.5% mortgages, and they're paying out a lot more in variable rate, and they have a negative book value position.
Yeah.
So the Fed was eating the same cooking the banks were in the same position. The Fed, of course, though, doesn't get a run on the bank.
Right.
The Fed can print money. So the Fed's in a different position. Now, the consequence of what that means to the value of the dollar, But I think what you're saying here is that in the next 1 to 2 years, we'll see a resurgence of bank fears come to the
Yeah.
fore.
Yeah.
And
As long as,
yeah.
I mean, folks want rates to drop a couple points, and it's the levered, and it comes down to leverage. We're going through a deleveraging right now.
Right.
Look at the Fed balance sheet. Look at M2. These are the effects of a deleveraging.
Now, to your point, I see M2 declining, but I see year-over-year positive bank credit growth. I'm looking at that directly. M2 is indirect, right? M2 doesn't tell you is credit expanding or contracting. And I do believe credit is a primary driver of the business cycle. So I look at that bank credit. It's still year-over-year positive.
Right.
It's not in the heyday of 8 to 15% growth like 2021.
Yeah.
It's low to mid-single digits, but it is positive.
Yeah, because there's a lot of clean shirts out there in the banking sector, and there's a lot of dirty shirts. And so the clean shirts are, making hay right now because they can lend at, you can lend at prime's, 8 handle. You can lend at 8-9% right now, and borrow at 4 to 5.
Right.
That's almost a better you would rather be lending at 9 and borrowing at 5 than lending at 5 and borrowing at 1. And you're kind of like, why is that? Well, if you're locking in 9% loans and you get the option if funding costs drop, whereas if on the 1 to 5, like, hindsight's 2020, right? Like, my funding might go up to 5 and I'm locked in at 5. Why do I want to be there?
That's a really interesting point because you got JP Morgan who's borrowing at between 0 to 1% on short-term deposits, so lending out at 5. Now that's corporate credit risk. They have a bunch of mortgages too. Then you have other regional and community banks that have higher short-term funding costs.
Right.
I don't know that they're lending at a 9% rate though. That's a pretty high rate. That's more of a private credit rate.
Yeah, I mean, I was on the phone, we were talking about kind of weirdo stuff like fix and flip loans, builder loans. Builder loans are at 10 to 11.
Esoteric, hard money lending.
Yeah, kind of. But, like I have personal loans at 2 different banks, and I'm paying prime plus. Prime's 8.25. There's a lot of paper out there that's prime based.
So, if you believe a Fed pivot, then your thesis is find the banks that have clean balance sheets, that have deposits, that don't have a high loan to deposit ratio because they can lend out with their excess liquidity, and then hopefully get long duration on those loans that they create. We'll see. It's probably, to your point, up to 5 years. And then if and when the Fed pivots, then their borrow cost drops. Their NIM expands. So you go along those banks.
Right.
And you'd want to avoid banks that have bad balance sheets, upside down economics, high loan to deposit ratios.
You want to look at loan to deposit ratio. You want to look at their book yield. So they all have to report what is their yield on their loan book and what is their yield on their securities book. Okay. This is all in call reports. I don't know if it's on Bloomberg or SNL, but
so call reports are on the FDIC website, or you have a tool like SNL Intelligence from S&P
that accumulates all of that. So they're going to give you those exact yields. They're going to break it down by their book. They're going to tell you kind of what the duration is on their loans and their securities. And so you can figure it out. It's not rocket science.
There's just a couple thousand banks to go through.
Yeah, but
the analytics.
You should get these guys on your podcast at BankRegData.
At BankRegData, I will do that. Thank you.
I started following their site last September, October, and they actually did a use case on Silvergate, and this is 4 months before Silvergate blew up. And I'm like, this is really interesting. So because I started thinking about this as I'm like, hey, these banks own it. I'm in the business, and I'm getting color. Banks aren't buying anything. Banks are dead. And I'm like, okay, what's going on here? Well, they own all these Fannie 2 and 2.5% coupon bonds that are down 10 to 15 points. Duh, And second to that, short-term rates started going up. You start getting like 2.5%, 3% CD offers, right? Money, and I got my money at JP Morgan at 0.01. And I'm like, what's going, and so it's like, okay, I'm not alone in thinking we're starting to get, kind of topsy-turvy here.
Right.
So then BankRegData is a kind of a layman's it's a website, much lower fee than what you would pay SNL or S&P for bank data.
Yeah.
And so they're just looking at call reports and being like, hey, these are the banks that have negative equity. And it's very simple. They have more losses on their books than they have equity.
It
and that's
like
it.
A good thesis for a long short bank hedge fund strategy.
Right.
This is a fundamental analysis. You can manage your exposures. You can get long the good banks, short the bad banks. There's value in the long banks, and the banks that don't have enough capital are going to have issues. And it's a large fragmented market. This is not something a retail investor or family office can do. It takes specialization, skill, understanding how banks work.
So and quite frankly, a lot of the bank analysts, and there are bank hedge funds out there, folks don't really want to do a deep dive or cannot do a deep dive on the securities portfolios, okay? Because you can't just look at, here are your maturities, or, here are your coupons.
There's not enough transparency.
Exactly. And so, plenty of banks a year ago were saying, we're fine. We own 100% agency securities. This is, I saw what Silicon Valley Bank and First Republic owned. It was almost 100% agency.
Right.
It's all money good, zero credit risk paper. Right. And this is also what's going to change the fixed income market, okay? Because when you look at indexing in fixed income versus indexing in equities, if you index in equities, you own everything, okay? I put my kids in FZROX, which is a zero fee fidelity fund that owns every stock in the United States, okay? Because I don't want to miss out on the next Monster beverage, which is the best performing stock since the year 2000.
10,000%, something like that.
Exactly. It's beaten NVIDIA, Microsoft, Facebook, Google, you name it. Okay. Right. But in bonds, if you own the index, you own all of this, all this paper that was issued post-COVID at really low coupons. And what's the best you're going to get on bonds? Par. You're just going to get your money back, right? Plus your coupon. Mm-hmm. So yeah, and so the banks were doing the same thing, just blindly going out and buying new issue paper, and people are like, well, you didn't hedge. That's not your job. You don't buy something at 2% yield to hedge out your interest rate risk. That gets you to zero. You're investing at zero. And so
the hedge equals the coupon on the asset.
Yeah, it's there is no hedging, but the risk management on the bank side is very, very non-existent for some newer banks as well as a lot of community banks. You have one person that's doing it all.
But it takes a lot of skill. I mean, to your point, they're a 10x levered institution. They're a hedge fund that is constrained on the assets they can invest. They're not buying equities, but they are investing in bonds and real estate. And those are fixed income products, fixed income like properties. And the CEO of a bank needs to act and think like a CIO and a portfolio manager and a risk manager. And they're great banks out there.
And they're head of the loan community, and they have to, cut the ribbon at the new building that's opening next door.
That's right. But there are great, exactly. That's hard to do all that. Exactly. You need specialization. You need the CEO has to understand all. But there are good banks, plenty of good banks out there. Bill, PNC, and of course JP Morgan. But even big banks that make mistakes, like Bank of America, with their unrealized hold-to-maturity loss of upwards of $100 billion, which is it's bananas that they did that. Of all the banks in the United States that should not have made that mistake, it should have been Bank of America. They've got the money, resource, talent. They own an investment bank. They own trading businesses.
Well, it made sense at the time, right?
So what's your outlook on rates? Bill Ackman
Right.
expects a Q1 pivot, citing lower inflation means that you have higher real interest rates. So the Fed is tightening even when the Fed isn't raising the nominal rate. Is his argument. That's true.
Yep.
I agree. Real rates are going as inflation goes down, even the Fed is holding steady. Do you think he's right about a Fed pivot or preemptive insurance cuts starting in Q1?
I don't see the government needing less money going forward. I don't see the budget cutting, or I don't see the U.S. government going from a deficit to a surplus, meaning the government has to continue to issue treasuries
Correct.
to fund, right?
Yeah.
Now, what we need, what I see with the government not buying and banks not buying, there's a huge supply and demand imbalance for U.S. treasuries. So in order for U.S. treasuries to go down, you need more buyers than sellers. You need more demand than supply. Okay. So I think we got very, very close to that. And I think a large portion of this rally was pensions and insurance companies looking at 5-handle yields on longer dated US treasuries, which is where they were a month ago, and saying, hey, like a lot of the pensions have actually become fully funded all of a sudden in the last 2 years, right? We're talking about 104, 110% funding ratio. So if you can put that money, and why is that? Because they're using a discount rate of where basically corporate bonds are. Corporate bonds were at 2, it's a much higher liability on their balance sheet than if corporate bonds are at 5, right? So what they were able to do this month is they were able to lock in that fully funded ratio for the next 30 years.
Let me play that back for the audience here. So
Yep.
What a pension is doing is they're trying to match assets and liabilities. Their liabilities are commitments to their employees to pay out certain obligations. And the higher the discount rate or the interest rate, then the lower the present value of all those liabilities. So as interest rates have gone higher, that's improved the funding of the pension. But you also need the assets to not decline from higher rates. That's key. That didn't happen in the UK market with pensions in late 2022, of course,
Right.
And different pensions are different. So look, Japan's a marginal buyer of U.S. Treasuries.
That's a really other good question. Okay, who's going to buy? So we've had duration buyers step in, pensions, insurance companies, but when the U.S. government seized Russian currency reserves, $800 billion, they sent a message to foreign buyers and said, I can't guarantee that when you buy these treasuries from us that you're actually going to get paid back. So if I'm China or Vietnam or, Venezuela or what have you, I think they diminished a large portion of buyers out there. Okay. Further to that, there's been a gigantic yen carry trade going on since 1997, the Asian financial crisis. Japan has kept rates artificially low at, call it 0. Okay. And so everybody and their brother in the world were able to borrow yen and invest in U.S. treasuries or other, bonds out there and make a spread. Now, the Japanese government has come out and eliminated basically that yield curve control, which is they were buying the long end of the curve and keeping their JGBs 10s at a very, very low rate. Now with that, that governor being taken off, I think we're going to continue to see, what we have seen is a lot of volatility, right? I think we're going to continue to see a lot of volatility. And anytime, the government's issued $27 trillion or something like that in the last 10 years, and they're going to have to issue a lot more money. And who are the buyers? We're, okay, you think 10s are going to 350? Who's going to buy them? Somebody has to buy them down there. Now it's very possible, but if that happens, I don't think that's a good sign. I think that's a bad sign. I think in you're looking at Jay Powell, who, as soon as Jay Powell was nominated or elected, I started reading about the 1970s and Paul Volcker and
Arthur Burns and all that.
yeah, Arthur Burns and anybody who's been in this market pre 2007, the normal interest rate out there was 5, wasn't 2.
Mm-hmm.
And so, Ackman is using kind of recency bias and saying, the market can't survive with real rates above 2%. Well, it survived for a very, very long time with real rates above 2%, i.e. everything pre-08. And so if I'm the Fed, if I'm Jay Powell, I want rates to be at 5. I think that's the neutral rate. And that's going to give me a lot of wiggle room when the next pandemic or, financial crisis comes to boot. I want to be at 5. I don't want to be at 2. So it's a supply and demand issue. And it's I don't see enough reason out there. If inflation's at 2 and unemployment's at 3.8, and GDP just printed 5 handle yesterday. If everything's going on all cylinders, why do you start cutting? Like, what am I missing in that equation?
I don't disagree with your assessment too. I don't expect any imminent rate cuts. At best, Q4. The economy is stronger than people expect. It exceeded expectations for 13 quarters in a row. In the last few months, you're starting to see misses, but also some beats. So it is slowing down. My metaphor is that it's like a ice cube that's melting, or a car that went from 120 miles per hour to 55 miles per hour. Now we need to see if it stabilizes there or continues to slow. But I agree. I don't think we're going to have a Fed pivot. There's a lot of Fed pivot talk across both research desks. And that was a non-consensus view at last time this year. If you recall, Fed pivot was what the forward rate curve was suggesting, and that didn't happen. And that's a liquid market. And you can get a lot of others in that market. People made a lot of money not betting on a Fed pivot.
Right.
And obviously, markets have calibrated a lot more. I think there's something like 3 rate cuts priced in for next year. So we'll see. But I agree with you. On the marginal buyer, with Japan's rates going higher, I don't think that influences their demand for U.S. Treasuries. I don't know if they care so much if the spread diminishes. The other point is when China president visited California, there was a news article about Secretary Yellen, quote unquote, having intensifying talks with her counterparts in China. So they're aware of the issue for sure. How can you not be? And they're looking for some way to throttle down the U.S.-China relationship, I believe, so they can get China back in the market, which they've pulled back substantially from buying bonds.
Yep.
And the inventory has also declined while rates have gone up, meaning they've been selling as rates have gone up and incurring some losses. But they're a central bank. They don't have to worry about the P&L issues from that. So other buyers are Americans. Americans have been buying TLT.
Right.
I can't tell you how many conversations I have with people on the phone, our clients and others are like, buy. I'd rather invest in private credit. I don't know why I want to invest in it. I get a teens coupon for a private credit return. You explain one strategy, and there's plenty of others.
Right.
So what else? We covered a lot of ground. We talked about the housing market, the rate market, bank sector, the consumer balance sheet. Any other topics that you wanna share?
Yeah, you just talked about TLT real quick, and I just want to talk about really the concept of risk reward in fixed income, because we're talking to a tremendous variety of buyers out there, investors, large multifamily offices, endowments, foundations, RIAs, insurance companies, banks. And there's 2 sets of deer in headlight right now, which is either A, I'm earning 5.25%, 5.5% in cash, or B, I'm down 15% on my traditional fixed income, investment. I think I'm just going to wait it out. And at current yields, which are about 5% on the ag, if you're waiting it out here, it's going to take you 3 years just to get your money back. And then when you look at the forward curve and you own bills right now, you're saying, yeah, I'm fine earning 5.5, knowing fully well I'm going to earn 3.5 in 2 years from now. So there's definitely pockets out there. You mentioned private credit. I think you could look at high yield munis. You could look at high yield corps on the safer side, double B side. We invest in non-agency mortgage bonds, but also even agency bonds, where I think you can put together a really high quality yielding portfolio with very low risk at high singles. Versus, this is kind of breaking down the 3 things that we invest in. Current yields on agency at 6, AAA paper at 6.5, and legacy at about 8.5. I list where spreads are currently to U.S. Treasuries and where we think they can go. And that's not like where they're going to go back to the low, but kind of more median. Yeah. So not only are you getting those base case yields, you're also getting price appreciation with spread tightening.
I like the thesis. Yeah.
And so you're looking at, 10% yield, on the safe side, mid to high teens on the, going out the curve a little bit. And that's with, you're investing in an asset class that the borrowers have 50+% equity in their home. So it goes back to just my point of now and for the next 2 to 3 years, and you're seeing this all of a sudden, all these private equity guys are talking about private credit, right? And so think about that. I'm talking to real estate developers, real estate private equity guys that are pinging me talking about real estate private debt. Like, oh, I have the wherewithal now to not just buy, value add multifamily. I have the wherewithal to actually lend to these multifamily GPs. Well, the tide has shifted, and the market in general is a pendulum. Mm-hmm. There are times when you want to be a lender, and there's times when you want to be on the equity side. Okay, and now for the foreseeable future, credit is going to dominate because the risks have dissipated in many sectors, and the rewards are higher than we've really seen.
You're getting equity
since the late 80s.
Right.
Yes.
So you're getting equity-like returns for taking credit-like risks, right? The long-run average annual return in the S&P, so somewhere between 9 to 12%. We had a record run in the 2010s with the ultra-low rates in QE. And here you can take government risk and get an attractive coupon. Now, you're going to get taxed on ordinary income, et cetera. So you got to consider that and how you fund it, ideally out of a tax-advantaged account.
Yep.
But no, I agree. I think that legacy non-agency RMBS story is nice too, because you're also betting on the housing market if you like that bet.
Right.
And you need more houses, not enough houses to go around. That was a bet I made 10 or 12 years ago.
Yeah. And it's still the case. There's still you look at the rise of single family rentals, single build to rent, there's still a bunch of plays there where the economics around renting versus buying are just kind of, topsy-turvy right now.
What vintage is that legacy non-agency RMBS strategy?
That's like 06, 07, so old. And, what's really interesting I talked about prepayments earlier, but what's really interesting on the prepayment side is none of the models that forecast prepayment rates incorporate borrower age. Okay. And if you think about a borrower that's been in their loan for 17 years now, they've probably been in their home for 20 years. They're in their 50s. So if you're 52 to 55 years old right now, you have I'm 43. My youngest kid will be going off to college in 11 years. Voila, 54 years old, sitting in a big house. And I'm like, do I need 5 bedrooms still? And so these borrowers are coming up on significant life events that will either force them or encourage them to sell and pull out 50, 60, 70% equity and downshift into an Airstream or something like that, live on the road.
And when they refinance, because you're buying these bonds at a discount to par value, you benefit.
We get paid par back quicker.
Par, right.
Yeah.
And what discount are you buying relative to par?
65, 70 cents on the dollar.
I'm amazed that those discounts still exist.
Yeah. It's and it's only gotten cheaper because you've had a lot of forced sellers, a lot of fixed income investors, and that's this is really cool too. When you talk about borrower psychology, people want to buy when prices are going up and sell when prices are going down.
Right.
People think they're timing it right. The bond market's up 5.25%, 5.5% this year or this month. Right. And it's like, man, now you're actually seeing a lot of inflows in right now because folks are like, all right, I'm going to ride that train. But it's one of those things where it's like, no, you kind of have to, if you're buying in at a 9% yield, you got to be comfortable with that. Don't wait until the market's up 5% to buy. You want to buy, and listen to Warren Buffett, buy when prices are going down.
Right.
And if you just really follow that mantra, I'm going to always buy when prices are going down, and I'm going to sell when prices go up. You're not going to time it perfectly.
It's mean reversion, counter-cyclical, provide liquidity from the market.
Yeah.
Take liquidity from the market when there's excess liquidity. That's when you want to be a borrower. That's when you go get a house with a 2.5% mortgage.
Yeah. And so that goes back to, like, there are times to be lenders and times to be borrowers. And now's the time to be a lender. I don't want to borrow at 9, but if I can find good credits that want to borrow at 9 to 12, great.
Right. Now, what's your sense of the equity market? I know you run a hedge fund focused on credit risk and fixed income, and I totally appreciate you get equity like returns for credit like risk. We're a cross asset class investor. We do stocks. We also do alternative investments. We do private credit. We've also been long equities this year. That's been non-consent. It's been terrific. When I talk to you, Skylar, I want to get back to my turtle shell.
Yeah.
So how do you interpret what this means for the equity market?
My position on equities is not to have a position. Know what I don't know. But I am a student. I read a tremendous amount, and I'm a student of markets. And it goes back to that, hey, look, what's the number one performing stock since Y2K? Maybe I ask that all the time, and maybe 1 out of 15 people answer Monster. And it's usually NVIDIA or Microsoft. And so I'm usually talking to an RIA that's a stock picker. And I say, you must own a ton of Monster. You must have killed it, right? And they're like, no, we don't own any Monster. We're value and Monster price doesn't make any sense. Well, if you don't own the entire market, you're going to miss out on the next Tesla or NVIDIA or GameStop.
Well, you're playing the same strategy as venture capitalists do. They want to capture that power law distribution, that tail outlier that returns 3 times the fund.
Yep.
That's why you're doing a broad sweep.
And you have to, okay, that ETA or that mutual fund I mentioned is up 18% this year. It's not horrible. And you're going to capture small caps and large caps, and you're going to capture this weird market this year where mega tech firms have, the equal weighted stock portfolios flat and mega techs are up 25 or 30%. Like, no one was talking about that at the beginning of the year. And so it is, you look back at the two kind of final points here, which is the stock market actually has a very long duration. Yes. What do I mean by that? Look it up, Google it, Google duration of the S&P or the stock market. It's 20 years. Okay. So there's charts out there that are like, here's where stocks have gone this year and here's where bonds have gone this year. There's this really wide, but it's followed pretty flat on. If you follow the 20-year Treasury relative to the S&P or the Q.
This is like the equity risk premium argument, right? You overlay the earnings yield in the S&P against the 10-year note. Arguably, you could do the 20-year and look at the incremental compensation you take for taking equity risk over a comparable duration Treasury.
Yes. So if that 20-year bond was down, call it 20 to 25% over the last 2 years, stocks should have been down that, and they're not. So that's part of the equation. The other part is just, also over time, generally active equity managers don't beat the market. And so, and on fixed income is different, because fixed income, there aren't, how many people right now on this phone call are analyzing Apple stock? At least 1,000.
It's too efficient. Yeah, it's a competitive, efficient market. It's
Right.
hard to get an edge on Apple. There's complacency. I'll challenge you on this point. This is a wonderful book. It's called "What Works on Wall Street" by Jim O'Shaughnessy.
Okay.
It's a fundamental based quantitative approach. Essentially, there are a couple of conclusions. I won't walk through all of it now, but you look for quality, value, momentum, and the track record of these strategies backtested for decades outperform, the S&P. The S&P is really a large cap index, and large cap can work great too. So can small cap, so can value, so can growth. They perform in different kinds of cycles and different kinds of environments. And why active managers underperform, and I agree many of them do. I've talked to plenty of active. I'm always looking for quality managers. If I see an active manager own Apple, like, meeting's done. I'm not paying you to own Apple. Why are you buying Apple?
Right.
But yeah, no. So your point is, hey, look, I don't own any equities.
I do, but I don't.
Yeah.
I if anything, if I'm starting to talk about equities and individual stocks, it kind of clouds my brain and versus to focus on other stuff. But yeah, I get equities. I get over the long run, and it's really more just your role as an advisor and an allocator is like talking with your clients. Like, look, we don't want to sell when prices are down. You want to buy when prices are down.
No, I agree. We were buying mid to late October, and we went tactical underweight August 1st.
Yep.
Because of valuation considerations. Not only that, because valuation is a lousy timing tool, but we saw retail call option activity was at a peak. We saw open interest. We saw just a lot of speculative animal spirits. And the AI narrative was in full bloom too.
Right.
But all right, why don't we take some chips off the table here? And like you said, you got to be counter-cyclical as well. We'll talk about equity some other time though. It's fun to go there too. But thank you so much. This was a real pleasure, Skylar. Really appreciate it. We'll do this again, in the next quarter or so.
Yeah, no doubt.
All right.
Thanks, Ron.
Take care.
See you.